Next, we'll take a look at ratio analysis. Ratio analysis is taking two numbers and placing one over the other to form a fraction or a ratio. It's basically a way to compare one set of numbers to another, and what that allows us to do is take out any type of scale difference between comparing two different companies or a company over time. It's a very powerful tool. It looks at retrospective information, that is, looking back at the past. The ratios come from the financial statements, where you're comparing one number to another. It could be two balance sheet numbers, it could be two income statement numbers, like price-earnings ratio, or it could be a balance sheet number compared to an income statement number. Those are the usual ways that ratios are formed. They first became popular in the 1930s. In 1933 and 1934, after the stock market crash of 1929 and the onset of the Great Depression, it was looked at to start a government agency that would police publicly traded companies. One of the requirements became that these public companies would now have to file audited financial statements. That was never done before. So suddenly the public had access to all of these publicly traded companies' financial statements, and we started to wonder about what could you do with those numbers to make some meaningful and intelligent decisions based on those numbers. And a fella named Benjamin Graham wrote a book in the late 30s called The Intelligent Investor, where he went through and basically using ratio analysis looked at these financial statements and said, here's ways that you can compare apples to apples, these different companies, and start to compare which is a better investment, or look at a company over time and see if its value was eroding or actually increasing. That became extremely popular. One of the iconic disciples of Benjamin Graham is Warren Buffett. And Warren Buffett took that information, and basically that's how he has made his career. His investing career is predicated on value investing, and that's the Benjamin Graham type of way. Benjamin Graham, in subsequent editions of that book, had a co-writer called Dodd, and it's Graham and Dodd's Intelligent Investor now. I suggest you pick up a copy of that book and check it out. It's a fascinating read, and it's the way that all smart investors start out to look at value investing, looking at companies and looking at their value. So now we'll take a look at these ratios from the book chapter here, and it'll give you a good idea about how these ratios are put together and what they really mean.